I think for us, the most important thing as investors and as operators or sponsors, whatever position we occupy now or whatever position we aspire to occupy, is really being able to ascertain the information that we need and to obtain the information we need and to be able to interpret that. And what this process does, this market research, this seeing where everything is, where it's going, et cetera, helps us make better investment decisions, as well as just understand again where the opportunities might lie, and where the next window of opportunity might be. So as we are at the beginning of the year, I want to start by just taking a look at some data from third quarter. This was published by Newmark, and Newmark is one of the top 10 uh, international real estate services company. And by real estate services, they provide a lot of different services from like valuation to data to research to brokerage and stuff like that. This report came out, I believe it was November 11th. And the reason why I'm starting here is because it covers a good deal. One, it covers a good deal of 2019, and it with three quarters out of the way, it summarizes pretty much what the momentum was for 2019, or excuse me, not 2019, what the momentum was for 2020 as we were heading into the fourth quarter. And then as we kind of look at that overall 2020 snapshot, we'll end by looking at some 2021 data. And actually, although today is January 14th, we're still a little bit early in terms of a lot of the Q4 data coming out for multifamily. So that's another reason why we're taking kind of a step back and looking at Q3 data, because all of the Q4 data hasn't really come out yet. So there is only a few pieces of information out there, and we'll cover that. But anyway, this is again from Q3, and just let me know if you cannot see my screen. I'm going to scroll down to this one is about 26 pages, and I'm just going to try to summarize each page and contextualize it a little bit, and we can keep moving, and hopefully we'll be off of here within I say about 40 minutes. Hopefully I'll definitely keep my eye on the clock. And then if you have any questions, feel free to ask. I see Angela. I see you, Angela. I see you, Tanisha. I see you hopped on Facebook. Detroit in the building. Angela, let us know where you're watching from. All right, so let me zoom in a little bit, make sure you all can see this. Okay. All right, so this first slide is talking about the sales volume, which is actually in billions, but the sales volume leading up through through the third quarter of 2020, for the third quarter and investment sales volume. Now, mind you, this entire presentation really is from the commercial standpoint, and by commercial, that's 5 or more units, but it's also indicative of, it gives us a good idea of what's happening in the residential space, the 2 to 4 space. That data is not as published, as well published on a national basis. And I talked about this the other night, but all of this data is in that commercial space. But again, that commercial space starting at 5 units. But of course, if you're in the residential space, you may have some aspirations to jump into commercial, but nonetheless, it'll still help you contextualize what the demand is looking like, what the demand looks like, and kind of how the capital is flowing through the economy. So investment sales volume in third quarter of 2020 was 24 billion. Now, this was a 51.2% decline compared to the third quarter of 2019. And over the past 12 months, sales volume totals declined about 28% to 135.8 billion versus what they were in the fourth quarter, from fourth quarter 18 to third quarter 19. Now, although the volume up until the third quarter was still down, investor confidence in multifamily had dramatically increased, because the quarter over quarter from second quarter to third quarter, investment increased by 55.9% quarter over quarter, which makes a lot of sense, because if you remember, you had quarter one that ended in March of 2020, and March was right right around the time when we started to have, basically on a national level, international level, we started to have countries and states and things like that shutting down. And so the second quarter was really up in the air, and people were really just trying to figure out basically, what was going on. And as things started to normalize a little bit, people, investors started to stick their head up and started to continue to invest. But if you look at the chart, you can see that in the first quarter there was about 40.1 billion in investment. In the second quarter there was only about 15.4 billion in investment, and then in third quarter there was a ramp up of 24 billion. But as you can see, compared to 2019, and to contextualize that, 2019 was actually a record year for multifamily sales. It was the highest year, at least in the last 20 years, in terms of transaction volume and money being poured into 2019. So to go from a record year in 2019 to where we are, or where we were in 2020, there was a significant change in investment value. This chart here is basically it's the same information as the prior one, except it's breaking the quarterly sales down to a monthly basis, and it's just showing us month to month all the way back until March of 2010, just how the ebb and flow of investment transaction has transpired month to month. Towards the end of the chart, where we have December 2019, you can see actually December 19th, 2019 was almost, if not tied, for the highest month in terms of closed transactions. That was December of 2019. And then January and February, we saw a significant downtick. And then by the time we hit April, we hit May, and we hit June, we essentially were not at the lowest levels on record within the last 10 years, but all close. We were getting there. We were about halfway to reaching the lowest levels. And then as you can see, by March of 20, we started to see that uptick again. All right, so moving down, and I'm watching you on Facebook again. If you have any questions or comments, go ahead. If you are on Zoom and you have any questions or comments, just unmute yourself and go ahead and throw them out, because I'm not able to see the comment box as easily. Now, moving to the sales volume by market, and this is on a 12-month period. Now, one of the biggest changes in last year is where the investments were being made. So major markets like LA and New York, urban environments, they saw a drop of investment activity because a lot of people were leaving the urban centers to go. A lot of people were basically just going back home, or they were looking for more rural or suburban areas where they could find more living space, since they didn't have to be in the office and they could work remotely. So that did have an impact on the investment activity in these major cities. But still, with that being the case, Los Angeles and New York still were pretty liquid markets over the last 12 months. And then markets like Atlanta and Dallas had continued to see an increase of investment activity. And actually, Atlanta and Dallas, as you can see, really are one of the top 5 markets in terms of investment activity. You got the Dallas Fort Worth activity, the Dallas Fort Worth area seeing about 9.2 billion in activity over the last 12 months. Atlanta at 6.8 billion, and over the last 12. You still got 9.6 billion at NYC, but I think those NYC numbers were a little skewed because of the property values. And then you also have a lot of multifamily properties in New York. So although that number was higher, it could be skewed based on some of the demographics and the statistics of the properties. LA, 8 billion. We said Atlanta at 6.8. DC was still at 6.1. And then as you look across the country, all of these dots, you can see just kind of some of where the the investment activity was. Houston was at 4.3 billion. Phoenix is another hot market that was at 4.9 billion. Denver, 4.6 billion. Chicago at 2.6 billion. Let's see, the Charlotte area at 2.7 billion. We got South Florida at 2.6, Tampa area at 2.5. So a lot of hot markets. Boston at 2.8, and we'll talk about some of those markets and some of the data in a little bit. All right. Capital flow analysis. So this one is, let's see, normally, now this one talks about basically normally investors during a global crisis, or following the last global crisis, investors were seeking out investments basically in what they call safe haven markets, major market areas. But with COVID-19, as I mentioned before, with the flight from urban centers, the investment activity was basically the exact opposite of what investment activity was following the global crisis. Again, right after the global crisis, money was jumping into major markets. Because of COVID and because people were fleeing the major markets, the investment activity and the investment focus shifted to more what they consider non-major markets. So this particular graph, the dark color on the chart, that's major market investment. As you can see, one, the investment activity, you can see that increase from year to year up until 2019 was a record year. But you can also see that between 2018 and 2019, really the investment activity really boomed. Really from 2015 until 2019, there was a huge investment in non-major markets. And then in 2020, 74% of investment activity was in non-major markets, with only 26% being in major markets. And that 26%, dollar for dollar, is the lowest amount of major market investment in, let's see, since 2001. Every year since 2001, the percentage of investment in major markets has been higher than what it was in 2020. All right, so we'll scroll on down. And just to contextualize that a little bit more, major markets are considered Boston, Chicago, the Los Angeles Metro, the New York Metro, the San Francisco Metro, the Washington, D.C. Metro, and then all other markets are considered non-major markets. Now, another very important area, and this is one we have been watching. If you are a subscriber to our weekly multifamily newsletter, then you've probably seen this throughout the months where we've been keeping track of how rent collections have been going. If you aren't a subscriber, you can subscribe. You can go to my Facebook fan page, and there's a link where you can subscribe to the newsletter. If not, I will put a link in the comments section of this video once everything is done, and you can sign up for that newsletter. But anyway, the rent collections have actually been, considering that we're in a global pandemic, and I mentioned this the other day, when you have Maslow's hierarchy of needs, at the very basic level of our needs as human beings, we need food, we need water, and we need shelter. And that shelter component really proved itself during the entire year of COVID. Now, this data again is up until Q3 of 2020, but we'll also take a look at the Q4 data that is available for rent collections. But looking at the rent collection percentages, and we'll just focus on the left-hand side. The right-hand side is basically from a fund standpoint, if you were invested in some type of publicly listed fund. But the data on the left-hand side is the data that comes from the National Multifamily Housing Council. And if you are familiar with the National Multifamily Housing Council, I would definitely encourage you to check out their website and get connected. They do a lot of advocacy, a lot of education, a lot of networking, and a lot of educating for the multifamily community. So anyway, April, now the light blue color is 2019 numbers. The dark blue color is 2020 numbers. If you look at the April numbers of 2019, rent collections were at 97.7%. April of 2020, they were at 94.6%. And then if you look at each month from April, May, June, July, August, and September, one of the good things is that rent collection was up above, at least at a minimum, 94.5%. And as high as, let's see, the highest month was June, which was 95.6%. 4.9%. Now, yeah, that's not 100% rent collection, but when you think about multifamily as a business, and we talked about this a little bit last night, every multifamily property you buy is basically its own self-sustaining business. So when you compare the performance of a multifamily property in terms of being able to collect payment from its customer, and you contrast that with other industries, one of them being retail, right? Retail, their numbers have dropped significantly. Sales volumes has dropped significantly. A lot of retailers have filed for bankruptcy. The same thing with the restaurant industry. A lot of restaurants have had to file for bankruptcy. So when you look at these numbers, if you look at the positive, that's an extremely positive number. Now, yes, that 5%, that 4% still represents a significant amount of people who have not paid their rent. But when you run your numbers and you do your due diligence and you run your analysis, hopefully you've already built in some type of economic allowance for vacancy, and so it does that collection rate doesn't impact your actual numbers that you projected anyway. And then if it does, again, staying on the positive side, rent collection, in my opinion, was still pretty strong. Now, keeping in line with the rent collection, we'll go into talking about the rent collection by market a little bit, so we can see how rent collection was affected, or how collection as a whole was, basically what the rent collection looked like from market to market. So, in terms of rent collection going up, the city that saw an increase in the percentage of rent collections, the highest one was Salt Lake City, Utah. Collections actually went up 1.3%. And then from there, you have an immediate, which is interesting, you have an immediate drop from 1.3% gain in terms of how many people were paying their rent to Tampa. Tampa was at 0%. So there was no change from the same period. Let's see, this was Orlando multifamily lowest rent collections in Q3, conversely markets. Yep. So this one is compared to the 2020 average. There was no change in Tampa. Tampa was at 0%. Sacramento, the percentage went down 0.3%. Oakland went down 0.7%. And then from there, you have a big drop with Inland Empire. I'm not even sure where Inland Empire is, but that went down 1.8%. And the chart goes all the way from San Diego to Houston to Minneapolis, Dallas. All of these areas saw a decline, with some of the highest being in Portland. Portland saw a decline of 3.4% in collection rates. Los Angeles saw a decline of 4.4% in collection rates. Seattle saw a decline of 4.1%. Las Vegas saw a decline of 6.3%, which makes a lot of sense because, as you know, Vegas is heavily dependent upon tourism. And actually, that's what the paragraph talks about. High traffic and tourism reliant markets were hit the hardest. Las Vegas being hit the hardest at 6.3% decline, and New York being at 4.9% of a decline. All right, so moving on from rent collections by market. This next one is talking about total returns. Now, while strong income has kept multifamily positive in 2020, the hit to capital appreciation has dropped total returns to 0.8% year to date. Though returns are lower in the short term, historical annualized returns for multifamily show strong yields over time, especially after a recession. In the 10 years following the global financial crisis, multifamily total returns totaled 9.1%. Now, this particular chart, it kind of makes me feel some type of way because the returns for a multifamily property are so individualized. So, like, yeah, statistically, you can look at statistical data, but you can also find a lot of opportunity depending on what type of investing that you're doing. So you may have seen capital appreciation higher than 0.8%. You may not have, but on average, they're saying that the appreciation was only 0.8%, which is the lowest it's been since 2010. In 2009, that percentage was at negative 17.5%. And in 2008, it was negative 7.3%. 3%. So that particular chart, I would say, take with a grain of salt because it also depends on the market. Some markets, the cap rates have dropped significantly, and there's not a lot of inventory. So appreciation has certainly increased. This next one is a follow-up to the total returns, where it gives a breakdown to total returns by market. Despite slow depreciation, growing multifamily markets like Salt Lake City and Phoenix have yielded the highest total returns over the last 12 months. Half of the top 10 markets by total returns are in the Sun Belt, a region that has achieved strong levels of population and employment growth and has attracted record levels of institutional capital. So this one is actually good because what I like about this is it helps remind us that although the average of appreciation was only 0.8%, you got to think about all of the markets around the country, right? That's large markets, that's small markets, that's literally the entire country. But there are certain market areas where people are investing or are there's more prevalence of investment. So the returns are going to look different. Like, for example, Salt Lake City, they're saying there was an 11.6% appreciation on average, Phoenix at 9.2%. And then that goes all the way down to Portland. Was at 0.4%. And then you get into some markets that saw a negative appreciation, like Houston at 0.5% negative. New York went down 0.7%, and Chicago at minus 1.5%. And I hope you all can see that. I don't want to make it too big because then it looks a little funny. All right, moving on down. All right, so the yield spread, this one is basically talking about the multifamily yield as compared to the treasury yield. The gray bars going vertical is the yield spread. The light blue line is the US multifamily average cap rate. And the dark blue line is the 10-year treasury rate. So towards the end of 2020, the 10-year treasury rate was at 0.69%, and the multifamily cap rate was at 5.7%. So if you don't know anything about cap rates, basically when as the market gets hotter, the cap rate is going to get lower because there's going to be basically a higher demand for less inventory, essentially. So 5.7%, you can see there was a slight dip in the cap rate, but then there was a slight increase in the cap rate, but still at 5.37% on average is extremely, extremely low. I mean, if looking at it, as you can see from 2001, we're actually at the lowest cap rate level that we've been in since in the last 20 years. And I definitely have seen that. I look at deals all the time, all across the country. And one thing that you will definitely notice that is that one, there are not a lot of active listings. And then two, for the listings that are active, the cap rate is being advertised in the 5% range. So inventory is extremely tight. But if you have the ability, if you have the skill set to uncover off-market opportunities, then you may still be able to find deals where the cap rate is not so tight and the competition is not so stiff. But nonetheless, things are tight right now. Now, looking at cap rates on a quarterly basis, cap rates nationally declined 4 basis points year over year due to a strong demand for multifamily product, despite a lack of for sale opportunities year to date. The non-major market yields compressed 15 basis points, while cap rates in major markets expanded 30 basis points. So even with that expansion in major markets, it is still extremely tight. The dark blue line is our major markets cap rate at 5 point, and this again was by the end of Q3 2020. Major markets cap rate was at 5.1%, and the non-major markets was at 5.46%. So still extremely, extremely tight market. Again, the lowest cap rates have been in the last 20 years. Now, the price per unit. The impact of COVID-19 on the multifamily market has been highly regionalized, varying in severity throughout different areas of the country. Due to the nature of the virus, the denser major markets have suffered more than their non-major counterparts. Major market pricing has fallen 12.8% quarter over quarter and 20.2% year over year, while non-major market pricing has seen a swifter recovery, up 7.1% quarter over quarter and 2.6% year over year. Again, the different nuances between the major markets and the non-major markets. But as you can see, just looking at the price per unit, you still have a significant difference between major market price per unit at 246,000, I believe this is, versus 146,000 average in your non-major markets. And even with that 146,000 average, there are still plenty of markets where you can get units for 40,000, 45,000, maybe even 25 or 30,000. You mind grabbing the water for me? Appreciate you. Where you can still get price per unit for well under $100,000. It just all depends on where you're investing and what your investing criteria is. All right, moving on down. Aggregate fund targets. Now, this one is definitely for anybody who is in the capital raising space and you are raising capital at a very high level, or you're trying to raise capital from some type of institutional venue. This one is about funds and how funds have redirected their fund allocation or their funds based on where we are in the market. So this one, let's see, in 2020, the light blue line is how much of a fund they've directed towards residential investments. The dark blue line represents all other major property types. So for 2020, looks like I'd say about 40%, they increased their fund allocation from 30% in 2019 going towards residential. It looks like they increased it by about 10%, maybe 7 to 10%, to about 35 to 40%. That allocation is now going towards residential multifamily investing. And they slightly reduced their investment in all other property types, which is good because that means there's more. It's good and bad. One, it kind of gives a reason to why cap rates have tightened, because you have a lot more money in the market. You have a lot more bigger money in the market. But at the same time, if you're raising institutional capital or you're raising from some of these private funds, that means there's more money available. At the same time, they're still investing in other property types. One of the reasons being there's prime opportunity for funds or groups of investors who have the money to be able to hold some of these distressed assets. So if you're looking or you're investing in, say, hotels, if you're looking or investing in office space, then or even certain aspects of retail, there's a lot of distressed opportunity in the marketplace. And if you can hold out for another year, another 2 years, then that certainly represents an opportunity for you to potentially see a significant return on your investment. So I'm pretty sure those funds are taking that into consideration and hedging their bets to try to win big. Now, this next chart, top buyers and top sellers. One of the things I like to do is I like to research different companies in the multifamily space, to just find out, who are all of the players. Want to find out what type of products, what type of services do they offer, what their geographical allocation is in terms of their investments. A lot of things you can learn by looking up the different companies and knowing who the different companies are in the space. So this particular slide is talking about who the top buyers and the top sellers were in the multifamily space over the last 12 months. So the top buyers, and this is in terms of billions, we got either 1 billion spent, 2 billion spent, or upwards of about 2 billion and a quarter, 2.5 billion. Number one buyer was Harbor Group International. Number two, Morgan Properties. I really like Morgan Properties because if you look up Morgan Properties, they are based out of Pennsylvania. And one of the crazy things about Morgan Properties is it is a private company. and it is a family company. And the reason why I like talking about Morgan Properties because it shows what's possible in the span of one generation. This company has a significant investment portfolio of multifamily properties. And honestly, it's quite amazing to see a company that has grown so significantly in a short period of time. Now, by a short period of time, I'm talking 30, 35, 40 years, but it just goes to show that if you're focused and you have a mission, it's really, there are no limits to what you can achieve in this multifamily space. Blackstone is another company that just has an amazing story. Blackstone is a private equity company. They don't only invest in multifamily space, they invest in a lot of different asset classes. But Blackstone is one of the largest private equity firms in the world, and they are one of the largest real estate owners in the world. They have about, I think, $550 billion worth of assets under management. That's another company that was started within one generation. Steve Schwartzman has a great book out called What Does It Take? I think that's what it's called. It's called What Does It Take? It's a great read. He co-founded the company with another individual, and they have built Blackstone to be one of the largest private equity firms over the last 30 to 40 years. But anyway, moving on from Blackstone, you got Invesco Real Estate. You have a REIT, S-REIT. You have Greystar, L&M Development Partners. You got Brookfield. You got Bridge Investment Group, UDR, Pride Rock Capital, Nuveen, B-REIT, CBRE Global Investors, and CIM Group. All of these companies spending at least about 700. It looks like about 775 million up to about 2.2, 2.5 billion. Your top sellers, Morgan Management. I think that is an arm of Morgan Properties, but I'm not 100% sure. You got Brookfield, you got Cortland, you got Aragon Holdings, Urban American, Greystar again. You have Aimco, you have Alliance Residential, you have Blackstone again, you got Wood Partners, Crow Holdings, that's probably from Trammell Crow Company, Equity Residential, Invesco Real Estate, PGIM Real Estate. I believe PGIM is Progressive. It might be, I think, Progressive Insurance, and then Radco Companies. Now, the dark blue line represents a single asset purchase, and the light blue line represents a portfolio or entity purchase where there were multiple properties involved. So some of these companies literally spent $1 billion on a single asset, or some of them sold a single property for over $1 billion, which is, pretty cool. But that probably represents a property that was 500, 600, 700, 1,000, or maybe even 3,000 units. Sometimes they trade units at a very high number like that. All right, moving on. Changes in pricing. This is quarterly average versus 2019 average. COVID-19 has brought about substantial pricing pressure in the major markets, with both New York and San Francisco experiencing considerable effective rent deceleration as well as price per unit change. On the other hand, a handful of markets, including Raleigh, Durham, Sacramento, and Seattle, have largely defied the trend as investors have been willing to pay up for a mix of growth and migration trends. When they talk about effective rent decelerations, they're basically talking about in these major markets, because people have been fleeing the inner, the inner cities, the urban markets, in order for these owners and operators to still be able to attract and to retain their residents, they basically have to give more concessions. And when you give more concessions, it impacts the actual rental rate that you are getting for the particular unit. So the effective rent is essentially the rent you're getting minus all of the concessions. So that effective rent deceleration means basically they've been giving more concessions in order to attract more residents. And we already talked about the price per unit changes as well. So this is just a different chart showing how the price per unit change has changed, as well as the effective rent has changed. All right, moving on. This is a better chart for us to look at the effective rent. This one is about effective rent growth. Effective rent growth remains basically muted, with quarterly growth at 0.1% and annualized growth at 1%. While rent growth is dampened in the short term, multifamily owners and operators are offering higher than usual levels of concessions to attract and retain renters during the COVID-19 pandemic, with the expectation that rents will rise again in the future. So, looking at the 20-year average, concessions are they're not at the lowest level they've been, but they are at the lowest level they've been at least in the last 10 years on a quarterly, on an annualized basis. On a quarterly basis, they're pretty low, but on a quarterly basis, it also goes up and down. So I'm going to try to speed it up a little bit. Effective rent growth by market. Again, Phoenix actually saw an increase in effective rent. Sacramento saw an increase. Las Vegas saw an increase, which is interesting that Las Vegas saw effective rent increase because they had such a significant decline in other areas. Where there were some markets that saw a decline in effective rent growth, like Boston, Denver, Orlando, Chicago, New York, Houston, Los Angeles, San Jose, and San Francisco, seeing the largest drop in effective rent growth at 3.4%. All right, scrolling down. All right, effective rent and vacancy by vintage. And this is a good visual. So the first column from the starting from the left is properties that were built between 1980 to 1989. The second column is 1990 to 1999. The third column is 2000 to 2009. And the fourth column is 2010 to present. And essentially, what this graph is showing us is, which is very consistent with, you can think about anything built in 2010 to present, maybe still being considered Class A. So basically, this is your Class A, your Class B, your Class C, and maybe your Class D property. The higher end of the market saw basically a slight drop in their effective rent and an increase in their vacancy by the year that the property was built. Class B saw a slight drop, and then Class C saw a slighter drop with, I guess this would be Class C, between Class C and Class D, depending on the market, 1980 to 89, seeing a slight drop, but also seeing some signs of rent growth, which is consistent when with the basically the economy being where it is. Class A properties have lost people because people have fled into Class B properties because they're cheaper. They're trying to save money. Class A properties have had to give more in concessions. And then your Class C properties, they've performed well, but they have seen a slightly higher increase in delinquency. So just to summarize this based on the paragraph, effective rents declined the most in properties built in 2010 to present, as most of this product falls in major markets where fundamentals have suffered the most since the onset of COVID-19. On the other hand, older properties, particularly those from 1980 to 89 vintage, have experienced positive rental growth and among the lowest vacancy rates based on increasing renter demand for suburban and lower cost options. All right, we're almost done with this one. And then the other ones are shorter from here. This is just giving us that good context about where 2019 was, as well as the momentum moving in, or excuse me, 2020, as well as the momentum moving into 2021. All right, supply and demand. This one is about absorption. Year to date, new supply nationally totaled at that time about 250,000 units, representing a 1.8% increase in total inventory growth. And let's see, the supply was met by about 219,000 of those units being absorbed, with 103,000 new units expected to be delivered in the fourth quarter of 2020. Landlords in high growth markets are in position to benefit from accelerating migration trends. So again, that's just showing us what our absorption rate is. Our new supply was outpacing absorption. And then in terms of inventory growth was actually at its highest level in about the last 4 or 5 years. And there has been a consistent and steady increase in overall supply since 2011 when it hit rock bottom. Rock bottom 2011 was the lowest number in terms of inventory growth in the last 20 years. And then we've been on a nice increase for since then. So looking at the 2020 year to date number, you can see that we are right at the peak from the last 10 years, but we're nowhere near the bottom in terms of inventory growth. So as well as absorption and new supply has been good and has kind of been consistent. Actually, absorption was outpacing supply in 2019, and that has flipped a little bit in 2020. Now, supply and demand by market. The dark blue line is new supply. The light blue line is absorption. So Dallas by far has had the most new supply with the with not the lowest amount of absorption, but definitely new supply has outpaced absorption by a pretty significant amount in Dallas. Atlanta is almost even between new supply and absorption. Houston is out of whack. You got a lot more supply than absorption. Phoenix is actually close. Denver is close to being in balance. Austin, you got a lot more supply than absorption. Charlotte is close to being in balance. Philadelphia is close to being in balance. DC definitely is out of balance. One of those major markets. You got a lot of supply, and you definitely had a lot of a lot of people fleeing DC. I can attest to that since I live out in this area. Portland, a little off, but close to imbalance. And then moving all the way to Los Angeles. Los Angeles has way too much supply and basically negative absorption. San Francisco, not way too much supply, new supply, but still a high number of negative absorption. And then the same with New York. New York actually having the highest amount of negative absorption, but also having still a healthy amount of new supply. So you have some locations that are going to have to correct their absorption and new supply as the pandemic goes on, but that probably won't happen until 2022 or so. All right, let's see occupancy rate by market. Multifamily occupancy rates still remain resilient at 95.6% nationally, despite a sharp increase in home ownership during the pandemic. And although being one of the most severely impacted markets at the beginning of COVID-19 in March, the New York metro area has actually retained the highest level of occupancy at 97.3% due to the resilience of the suburban markets and the outer boroughs. So looking at occupancy rates, New York at the highest with 97.3. And then you have Houston with the lowest at 93.3%, San Antonio at 93.6%. But even being at the lowest at 93.3%, again, keeping that in context, you still have significantly higher occupancy rates than a lot of businesses that are being forced to go out of business. So yes, it's putting pressure on the multifamily operators and owners. But at least if you have a higher quantity of units, you still got money coming in, you still got cash flow coming in. All right, and almost finishing this one up. This one is good to know from a mortgage debt standpoint. Total mortgage debt outstanding remained flat at 1.6 trillion quarter over quarter. From a quarterly standpoint, debt outstanding for government, I can't think of the word, GSEs, government specialized entities, I believe it is. Lenders Fannie Mae and Freddie Mac increased by 3.1% as they continue to make up nearly 50% of the overall multifamily outstanding debt. If you're looking at the chart on the left, GSEs, government entities, specialized entities make up about 48.2% of the outstanding loan market. Banks and thrifts at 29.5%. Life insurance companies at 10.4%. State and local government 5.8%. Collateralized mortgage-backed securities at 3.3%. And then other at 2.8%. So if you're looking for the sources of funds, the federal government is still supplying a bulk of that, and then your local and regionalized banks and credit unions and things like that. This next chart is just showing that loan volume basically by month. Looking to the far right, if you look at, let's see, January, February, March, April, May, June was the highest month in terms of outflow at about 17 billion. And then there was a slight decline, well, a significant decline for July and August, but then you had a significant uptick in outflow for September 20. And my guess being maybe June was maybe some of the deals that got tied down in the first quarter finally closed in the second quarter. And then since there was a drop off in the second quarter, you didn't have as many deals closing in July and August, but you had people contracting in July and August for a bigger closing and outflow in September of 20. All right, so that completes our basically our rear view look of 2020, and now we're going to jump into basically what some of the 2021 numbers look like. Definitely that portion is a lot smaller, a lot shorter in context, and hopefully we should be able to finish that within the next 10 minutes. So looking at Facebook, if you got any questions as it pertains to this particular presentation, just go ahead and put it in the chat box. If not, I don't see any as of right now. I'm just going to continue on to the next piece of data. Now, this next piece of data is coming again from, this one is coming from the National Multifamily Housing Council. And this one particularly, we're just going to take a quick look at how the fourth quarter fared in terms of rent collections. So I got to let this one load. And just so you know, the National Multifamily Housing Council, they publish this information. They keep a national tracker going, and they publish the information basically about every week to give you an idea of how the rent collections are pacing on a weekly and monthly basis. So looking at the rent payment tracker for December, really the second half of the year, this chart that is loading at the bottom of your screen. This is the rent payment tracker. It gives all, well, not all 12 months, but it gives the last 6 months of 2019 versus the last 6 months of 2020. If you look at October of 2020, the rent collection was at 94.8%. November was at 93.6%, and December was at 93.8%. So over the last 6 months, there has been a slight decline. July was at 95.7%. August was at 94.5%. September was at 94.6%. October again was at 94.8%. So you had rent payments holding strong at that 94, 95% mark. And then you saw a slight drop off ending the year at November, December at 93.6% and 93.8. Now that could be indicative of a couple things. One of them being the holidays, and people may have taken some of that rent money and literally may have spent it on the holiday, or it could have something to do with there were issues with Congress approving additional funding for unemployment and things like that. So that could be representative of some of the decline, but nonetheless, rent collections and rents being paid were still pretty strong. Again, considering the fact that basically a lot of places around the country have been shut down and money just has not been flowing the same. And then in comparison, year over year, looking at the percentages are off anywhere between about, I'd say about, it looks like from 0.9% up to about 2.1% drop off. The biggest drop off being 2.1%, and that's December year over year. December of 2019, rent collection was at 95.9%, and December again of 2020 was at 93.8%. So moving on from there, we're just going to check out two more pieces of data. This next one is just a chart going over where we are in the market cycle for multifamily housing around the country. And what this chart does is it explains basically the four phases of the economic cycle excuse me, as it pertains to real estate. And they have these market cycles for the various asset classes in real estate. This one is from a multi-family standpoint. And those four phases are expansion, hypersupply, recession, and recovery. Again, the four phases: expansion, hypersupply, recession, and recovery. So I won't go over every single market, but they do have a lot of markets listed. And if you have a particular market, I don't know how well you all can see this from your Facebook or from Zoom, given how, I know your screen could be a little bit smaller. But if you have a particular market that you're interested in, just put it in the comments or shout it out, and I will give you some numbers. But what I'll do is I'll just name out a couple markets and give you an idea of where they are in the economic cycle. So markets like Atlanta, Cincinnati, I got a lot of folks from Cincinnati on. Atlanta, Cincinnati, Vegas, San Diego, those markets are considered midway through the expansion phase. So there's still a lot of growth in those markets, because you go from the beginning, when you leave the recovery. Yeah, first I like to start off at the recession, right? So you have a recession. After you have a recession, you go through the recovery phase. From the recovery phase, you start to actually have the expansion mode. And then from expansion, you have oversupply. And then when you have oversupply, you move into a recession. So right now, those markets are right in the middle of expansion, which means there's still a lot of room for growth. You have some markets in recovery, like Memphis, Tennessee, Little Rock, Arkansas, Dayton, Ohio, New Orleans. You have some markets in the hypersupply, midway through the hypersupply market or cycle, like Indianapolis, Indiana, Pittsburgh, Sarasota, Florida, and Tampa, Florida. You have some markets getting ready to enter that next phase of, well, leaving the hypersupply phase to enter the recession phase. Those markets being markets like Denver, Colorado, Los Angeles, California, Naples, Florida, San Antonio, Texas, San Francisco. And then you have some markets at the beginning phase of their recession, and the middle of their recession, and towards the end of their recession. Some of the markets at the beginning of their recession in terms of the economic cycle for multifamily: Miami, Florida; Houston, Texas; New York; Wilmington, Delaware; Seattle; Portland, Oregon; Philadelphia, again in that beginning stage of their recession; Chicago, right in the middle; Boston, Massachusetts; and New Jersey, right at the end of their recession economic cycle. Now, just to caveat that, it doesn't mean that these markets still don't have opportunity and there isn't money to be made. It just means, on the whole, in terms of the total market, and especially for a lot of these larger properties, this is where they stand in terms of that economic cycle, which really could change very quickly depending on how things go with COVID. I like, a lot of people really have to, start to really take into consideration that the longer that COVID goes on, the longer it's going to affect these market cycles and impact our overall economy. So the sooner we can get past COVID, the sooner things will get back to normal and things will be a little bit more predictable. All right, so to finalize, we're going to finish up. We're right at 8:02. Now, moving on from there, we're going to basically head over to CBRE. CBRE, CB Richard Ellis, is the largest real estate services company in the world. They have like over 100,000 employees. They provide a ton of different real estate services to the commercial real estate market, and one of them being data and research. But they published a report sometime in November, just giving a brief prediction for what they think will happen in 2021. And caveat that, of course, nobody really knows what will happen in 2021. And I think, as I kind of glance through this, you'll see that some of it I think is a little skewed, because they mentioned that they are expecting, certain things to go well, like the vaccine distribution, and hopefully people getting back to the office space in Q1 of 2021, which, as we can see, I don't think that's going to happen. So anyway, to summarize, multifamily weathered the 2020 recession better than most property sectors. Only industrial held up better. We talked a lot about industrial the other day, but the market deterioration was far less than in previous recessions. CBRE forecast a return to pre-COVID vacancy levels and a 6% increase in net effective rents next year, with a full market recovery occurring in early 2022. If you remember, we talked about the effective rents on a national basis, and I think there was only one market that actually had a net effective rent increase of 6%, and then the rest of the markets weren't really close. They were around 2%, 3%, and some of them being negative. So I'm not sure I agree with an average of 6% increase in net effective rents for 2021. Let's see, vacancy rates for affordable multifamily housing will remain relatively low for 2021. Definitely a possibility. Unlike in previous recessions, more affordable housing in the inventory in the Class B and C maintained low vacancy rates and modest rent growth in 2020. We touched on that with people fleeing urban environments, which have a more prevalence for Class A multifamily, fleeing the suburban areas or fleeing the urban areas to go to suburban, where you have more of the B and C class properties. Development will remain robust next year, with most of 2021 scheduled deliveries. A lot of those were started, those projects were started long before COVID-19, and will likely reach 280,000 units on top of the estimated 300,000 unit total for 2020. And the level of new supply will temper improvement in Class A vacancies and rents in many markets. But as we looked at the absorption rates, we were slightly lower on average. I think it was about 30,000 units lower absorption than we had available supply as we were heading into the end of 2020. Quick mention again of the from the urban to suburban shift. The COVID-induced recession impacted urban submarkets much more than suburban ones in 2020. As a result, suburban markets will lead the multifamily sector's recovery in 2021, while urban submarkets will still lag. And then in terms of increased multifamily investment in 2021, with steadily improving market conditions, again, that's going to be dependent upon how we continue with COVID, but with steadily improving market conditions, multifamily investment volume is expected to increase in 2021. CBRE research predicts that U.S. multifamily investment volume will reach about 148 billion next year, which again, 2021 being lower than 2019's record level of 191 billion. But again, this is a 33% expected gain over 2020's estimate of 111 billion. Now, one of the difficulties with the market conditions is when you're doing your valuations and you're doing your valuations to acquire a property, you really have to account for how the economic market, how the job market, how the unemployment, how the back rent, how all of that may potentially affect your investment. And with everything being so up in the air, it's a little bit more difficult for you to make those analysis and make those investment decisions. So that's partly why that investment activity is still going to be down. And it's not because there isn't demand for multifamily or that multifamily is performing so poorly. It's just simply much harder to analyze these investments given the uncertainty of the environment that we're in. But nonetheless, CBRE predicts that there's going to be a 33% growth in 2021 of multifamily investment. And then in terms of investment strategies, and this is where we finish up, in terms of investment strategies, suburban assets in the Midwest and Southeast regions will provide the best opportunities for solid market performance and achieving expected revenues next year. In the Midwest, Indianapolis was the best performing market in 2020. Memphis, Detroit, Columbus, Cleveland, Cincinnati, Kansas City, Louisville, and St. Louis were also among the best in the country. Most Southeast metros weathered the 2020 recession relatively well. The leaders were Greensboro, Jacksonville, Richmond, and Virginia Beach. Atlanta, Charlotte, Raleigh, and Tampa also performed relatively well and are positioned for solid performance in 2021. And then finally, multifamily segments that had greater market deterioration in 2020, such as Class A assets in urban submarkets, particularly in those gateway cities, may not stabilize until well into 2021. I'm honestly thinking it's going to be 2022, and they present more of an investment risk But nonetheless, although buyers may be seeking pricing discounts for these urban assets, they cannot really expect that they're going to find significantly discounted pricings because it's still going to be hard to find people letting go of those assets. And the most impacted metro areas in 2020 were San Francisco, San Jose, and New York. And other underperformers included Los Angeles, Boston, Seattle, Oakland, Austin, Texas, Miami, Chicago, Washington, D.C., and Orlando. And finally, while the large, diversified, high growth metros of Phoenix and Dallas, Fort Worth, and Denver perform well at about the national 2020 average, their demand dynamics are so compelling that they will definitely be on investors' radar in 2021. So that's what things are looking like heading as we ended 2020. Good overview of the last 10 and 20-year trajectory, and then what we can expect for 2021. I think 2021 is going to be a strong market. I think there are still a lot of markets where you can invest in. Definitely, if you're looking for markets to invest in, you want to look for those suburban markets. You want to look for those smaller markets, not the New Yorks, not the Washington, D.C.s, not the San Franciscos, but those smaller Midwestern and Southeastern markets, as well as some of those around Texas and alike. But nonetheless, still going to be a strong year for multifamily. You can expect that inventory is still going to be tight. Cap rates are going to be tight. So definitely, if you know how to source off market deals, there is a premium, and there will be a premium paid for those deals that you're able to source. So if there are no questions or comments, and I'm watching on the Facebook. If there are no questions or comments, again, pertaining to the presentation, I appreciate you all for logging on, definitely for sticking it out. We covered a lot of dense information tonight, but nonetheless, if you are going to invest and you're going to invest on a big level, you got to get into the practice of doing the market research and staying abreast of where the market is headed. So thank you all for logging on tonight, man. It is much appreciated. I hope that you were able to get some good information out of it. I certainly learned a lot and was able to put a lot in perspective. And definitely stay tuned. We'll definitely be going live again. I think our next time going live is next Monday for Market Watch Monday, where we'll dig into one of these markets a little bit deeper to take a look at some deals and get a little deeper into that deal analysis and everything. So again, I appreciate you all for logging on, and that is going to conclude our live presentation. All right, y'all take care. Y'all enjoy y'all evening, and have a good night.